Today we're joined by Mr. Hamish Douglas, the co-founder of Magellan. Hamish, Magellan recently celebrated its 10-year anniversary. Can you tell us a little bit about the company you founded and the investment team?
Well, the history of the company, we set the business back up in 2006. It was set up by myself and a business partner, Chris Mackay. We actually set it up as a listed company that was very unusual. Back in 2006, we had 4 people in a serviced office in Macquarie Street. We actually raised $100 million to set the firm up then. Then in early 2007, we hired 25 people. The core of those people are all with us today, including the leaders of our investment team. So the guy, Gerald Stack, who runs our infrastructure strategy, joined in 2007. My deputy CIO, who used to run my financials team, Dom Giuliano, joined in 2007. Nikki Thomas, who's the head of research at Magellan, she used to run our franchise team. She joined in 2007. The head of my technology team, Chris Webster, he joined in 2007. So we've had the very core investment team together from the start. We've now got 6 global sector teams at Magellan where we specialise. We're a separate infrastructure strategy. We specialise in franchises and financial services, healthcare, technology, media and communications. And within our infrastructure group, we also do transport and industrials as well. And then we've got a separate macroeconomics unit. So we've now got 33 people on the investment team, and we've got over 100 people at Magellan. So from a very small start way back in 2006, we've now got 100 people and 40 billion of assets under management today, sitting here in 2016.
Can you please explain how your investment team is aligned with investors?
Yeah, well, we start at the firm. So the firm's got over $200 million of capital invested directly in the funds that we manage. We run a staff ownership scheme, which is voluntary, but we effectively provide an incentive with a 10-year interest-free loan for all of our staff, including our investment team, to invest in Magellan Financial Group that has $200 million invested in the strategies, and all of our investment team are shareholders. The vast majority of them also invest directly in the funds. And if you look at myself, who runs a global equity strategy, if you looked, and it's all disclosed because we're a public company, all of my incentive compensation is solely dependent on the 3-year performance of our global equity strategy. So I'm not in any way incented about earnings per share or funds under management. The only thing that matters to me for incentive compensation is the performance of our global equity strategy.
Hamish, I'd now like to spend a little bit of time on the research process of Magellan, with a particular reference to the Magellan Global Fund. Can you explain to us what the investment objectives are of the fund?
We've got 2 investment objectives of the strategy. The first objective is a capital preservation objective, and the objective is to have materially lower drawdown risk than markets have when you have an external shock or a big market down event. So that's the first objective. We want to have much lower risk when we get big drawdowns in markets. And the second objective we have is a return objective. We don't have an objective relative to a benchmark or an index. We have an objective to earn people a real rate of return on their capital, and we've set an objective to earn people a minimum return of 9% per annum over the medium to long term on their capital. That doesn't mean each and every year it will be 9%, because some years markets will be up 30% and some year markets will be down 20%. But on average, over the long term, we've set ourselves an absolute return objective of a minimum of 9% per annum.
What is the investment philosophy behind the strategy?
Well, the investment philosophy is really the integration of 3 different investment skills or disciplines. The first investment philosophy is to invest in a very high quality portfolio of 20 to 40 securities. Typically, we own around 25 names in the portfolio. I've got 33 people on the investment team, so we want to do a lot of intensive bottom-up stock analysis to make sure we're picking the right companies to invest in. So relatively concentrated, very high quality companies on a global basis. The second thing we do is we implement our macroeconomic views in the strategy. And we're trying to do 2 things. We may be trying to predict a macroeconomic cycle that we think is very probable to occur. A number of years ago, at the bottom of the US housing cycle, we actually invested back in 2011 and 12 about 10% of the portfolio in businesses, Lowe's and Home Depot. They were large home improvement retailers, and it was our view about there would over 4 or 5 years be a recovery in the US housing market. The second part of macroeconomics in terms of our philosophy is we're trying to avoid the big macro event risks in the world. So subprime happened and we did some particular things around the subprime crisis. The European debt crisis, we've done various things. There are a lot of issues that go on that you can see, and we're wanting to make sure we're managing that risk. And the third thing we're trying to do in the strategy is to effectively inherently build in resilience into our portfolio construction and risk management to mitigate the volatility or the risk on the downside in the strategy if an unforeseen event was to hit. There are things in the world that just happen, and therefore we inherently run a strategy that has lower volatility and lower risk than markets as a whole.
How do you assess a company's intrinsic value?
Yeah, well, in terms of intrinsic value, we look at two measures of intrinsic value. The very long-term measure of intrinsic value, our analysts do long-term discounted cash flow analysis of a business. So they project out into the future how much earnings and cash they predict a business is going to earn from now effectively forever. And then we discount it back at an appropriate discount rate, and we have to take a view on what the appropriate discount rate is, and we come up with an estimate of what those future cash flows will be worth today. A classic discounted cash flow analysis. But there's a lot of assumptions you can put into one of those models, and you change the growth rates a little bit and things, and you could get a false sense of security of just running that type of analysis, particularly in some businesses that may be a little bit more uncertain in the future. So we also look at probably a more medium-term view of what we call a total shareholder return analysis, and what we do is we take what the analysts are projecting a business may earn over the next 3 to 4 years, and we think about what the stock market would rate that business as, and we make a prediction approximately where we think, if the analysts are right, or where the earnings are going, where we think the share price is going. And then we take into account the dividends that the analyst believes the companies will pay over that 3 or 4 year period, and we come up with an estimate of what we think that total return would be over time. So one's a much more based on where the 3 or 4 year earnings are going and what we think the market will pay us for the business. And then we also take a very sort of long-term discounted cash flow. So we're looking through two lenses when we're looking at value or intrinsic value as you frame it.
You compare your portfolio with a football team. Can you explain this analogy to investors?
Yeah, at the end of the day, the football team analogy is you can only have so many players on the field at any time, and you have players in different positions. And we actually split our portfolio into a defensive team and an offensive team, and typically I'm holding around 25 players. So I have to make a choice. It's very easy to just keep buying more and more investments, but you're actually diluting your best investment ideas by doing that. So we keep the numbers on the team very, very strict, around sort of 25. I think I've held between 22 and 27 stocks over a period of 9 years now. And what we have in our defensive teams, we may own infrastructure or consumer staples businesses that are just much more economically resilient than markets, and we try and choose maybe owning the 12 best of those companies, which gives us enormous downside protection in much more steady type businesses. And then what we also have is an offensive team where I may have 12 players in the offensive position, and we specialise in technology, and we specialise in biotechnology, we specialise in financial services and consumer cyclicals. Those businesses inherently, we believe you can get more excess return out of investing in some of those businesses, but if something happens in the world, you're bearing more risk. So you need to balance the offence and defence, and you have to keep making sure you have the right number of players on the field. You never win the grand final in rugby union by putting 35 players on the field. You're only allowed 15. And at the end of the day, mentally I'm allowed 25. I just have to ensure we've got the best 25. So it's really measuring opportunity cost and making sure you've got the right combination of players on the field at any point in time.
You manage a concentrated portfolio of around 20 to 40 companies. Why do you believe in not overly diversifying?
Well, the reason we believe in not overly diversifying is because we don't want to diversify away from our best investment ideas. Of course, we have to have the risk management where we don't have all our eggs in one basket, and we never do. We have a whole lot of risk controls where we're never going to put too much investments around one particular risk. But at the end of the day, part of the skill here in order to generate people excess returns is to make sure we understand where the excess returns and then put a sensible amount of money to work. It's no use having your best investment idea and ended up having 50 stocks in the portfolio and owning 2% of it. Because even if you're right and it doubles or something, it just doesn't make any difference. But at the end of the day, if you own 6 or 7% in a stock that doubles, it actually makes a material amount of difference to the end outcome for investors. So it's really correlated between we have conviction in what we do deep analysis, and we have conviction in a properly constructed portfolio. 25 stocks in what we do is far and away enough diversified, but also has the opportunity on those stocks where you actually take a 5 or 6 or 7% position to make a meaningful difference to the outcome over time.
How do you determine the geographic disposition of the portfolio?
Well, how we look at it, we don't look at domicile. If people looked at our strategy, they may think I've only landed in the United States and never come back. But the reality is many of the large multinational tech and consumer companies of the world, most of these businesses all originated in the United States, or at least 70 or 80% of them originated, and we invest in a lot of multinational tech and consumer businesses in the world. So it looks like we're overweight the United States. The reality is most of these businesses have their business models all over the world. They're represented in most countries, probably outside, nearly every country outside North Korea, these companies have got operations in. And the question I say to people is, what do you think is the more American company, Nestle or Coca-Cola? Nestle has around 2% of its earnings in Switzerland where it's domiciled, but it has around 35% of its earnings in the United States. Coca-Cola, which kind of is quintessential American, has about 20% of its earnings in America and the rest of its earnings outside of America. So you're more exposed to the United States investing in Nestle than you are in Coca-Cola. So what we do in thinking about this equation, we look through. So we get from all our analysts and their models where the earnings are coming from, and then we aggregate all those earnings from every company we invest in and understand where our total exposure geographically is actually coming from economically in our portfolio. And I actually look at that on a daily basis.
You focus on the long term. How do you relate your investment process back to the recommended time frame for investors?
Well, I think you look at what we do at the end of the day and look at our actions over time. Our average portfolio turnover over 9 years has been around 20% per annum, which really indicates we've got around a 5-year holding period. If you look at how I spoke about intrinsic value, we're looking out 3 or 4 years into the future about where we think the share price will go. We've actually got no idea where share prices go in 6 or 12 months' time. But if we're right around the direction of the business, over time the market's a weighing machine and it should follow our view. So we tend not to make a lot of changes in the short term. We're not playing a game of gin rummy here where we're throwing out cards continuously. We would typically hold businesses for 4 or 5 years in our investment horizon, and we would actually say to investors they need to think exactly the same, because we could have periods where we substantially outperform markets and periods where we underperform markets. Our strategy looks nothing like markets. It's whether or not they're going to deliver over the medium to long term our investment objective of 9% per annum, and we genuinely invest, and our portfolio turnover is very consistent with what we say is how investors should think. They should really be thinking over sort of 5-year time periods in investing in the nature of a strategy like ours.